All right, welcome. So, today we're going to go way beyond the simple money rules you've probably heard a million times. We're digging deep into the real, fundamental laws that govern how wealth is actually created and, more importantly, how it grows. I mean, does this sound familiar? You're doing everything you're supposed to. You're saving, you're investing, you're working your tail off, but it just feels like you're treading water, like that scoreboard never really changes. It's a super common frustration, and it's because most of us are playing a game without knowing the real rules. And this is the big shift in thinking right here. The advice we usually get, it's like suggestions, right? Rules of thumb. But actual wealth, the kind that changes your life, it operates on a set of laws. Think of them like the laws of physics. They're not optional, they just are. And once you get them, everything starts to click. All right, so here's the game plan. We're going to talk about the real rules of the money game, the battle between speed and time, the power and leverage the wealthy use, how to actually build and scale your wealth, then, critically, how to protect it. And we'll wrap it all up with a checklist you can use right away. Okay, let's kick things off with law number 1. Money loves speed, but wealth loves time. And this is a huge one. It's this fundamental tension that trips so many of us up. Okay, check this out. This tells the whole story. Imagine you've got two friends, right? One of them gets into house flipping. He's constantly moving, flipping 100 homes over 5 years. And yeah, he's making cash. He's got speed on his side. But his friend plays a different game. He buys one property, then a fourplex, then a 20-unit building. He's all about time. So after 5 years, sure, the flipper has his cash. But the friend who held on to those assets, his net worth is 5 times higher. It's a totally different game. So now we get why time is so critical. Let's build on that and look at the next two laws. These are the tools of the wealthy: power and leverage. This leads us right to law number 2. The person who brings the money to the deal has all the power. And honestly, it's almost an unfair advantage. It doesn't matter if you're buying a company or a house. The one writing the check is the one who sets the rules, who controls the terms, and who ultimately captures the most value. And if you don't believe me, just look at this. It's wild. Take the Forbes 400 list, the richest people on the planet. Guess how many got there just from their salary? 0. A big fat 0. Okay, a few, maybe 15, got there by selling their business one time. But look at the huge majority, 385 of them. These are the people who are constantly buying and building assets. They're the ones with the power. All right, on to law number 3, and this one is maybe the most misunderstood tool in all of finance. Leverage multiplies everything. You know, we're often taught that debt is a bad thing. But for the wealthy, when it's used the right way, it's the single biggest accelerator you can have. Let me show you what I mean with a super simple example. Okay, so let's say you've got $1 million and you buy a house, all cash. The market's good, and the house value goes up by 10%. So now it's worth 1.1 million. You just made 100 grand. That's a 10% return on your money. Pretty good, right? But watch what happens when we add leverage. You buy that same $1 million house, but this time you only put down $200,000 and you get a loan for the other $800K. The house still goes up by that same $100,000. But think about it. You only put in $200,000 of your own cash, so that $100,000 profit is now a 50% return on your investment. See? That's the insane power of multiplication. Okay, so we've got our tools, power, and leverage. Now, let's talk about the engine that actually drives this whole thing forward. This brings us to laws 4 and 5, all about building and scaling your wealth. And this right here is the heart of law number 4. You have to know the difference between cash flow and equity. Look, cash flow keeps you alive. It pays the bills today. But equity is what sets you free. That's your wealth for tomorrow. Just think about McDonald's. What do they sell? Burgers and fries, right? That's their cash flow. But where's their real jaw-dropping generational wealth? It's in their $45 billion real estate portfolio. They're a real estate company that happens to sell burgers. Okay, this leads us right into law number 5. We need to look for what's called non-linear risk. Most people think about risk and reward as a straight line. You risk $1 to make $1. But the smartest investments have what's called an asymmetric upside. Venture capital is the perfect example. A VC firm might invest in, say, 5 companies. 4 of them might totally crash and burn. But if that 5th one goes 100x, it pays for all the losers and then some. You're always looking for those opportunities where you can risk a little for a chance to win a lot. So, building wealth is great. It's exciting, but it's only half the game. The best investors in the world know that rule number one is don't lose money. So now we have to talk about protecting your empire. Let me tell you a quick story, and this one's a tough one. A friend of mine and his wife had saved up over $700,000. This was everything, their entire life savings built up over more than a decade of hard work. Then he gets pitched on this can't-miss oil and gas deal. On paper, it looked like a total no-brainer. So he put it all in, the whole $700,000 into that one single investment. And 2 years later, poof, it was all gone. 15 years of savings vanished in an instant. And that story perfectly sets up our next law. So the lesson there, the really tragic lesson, brings us to law number 6. You do not bet the empire for a pot of gold. See, his mistake wasn't necessarily that the investment was bad. The mistake was the size of the bet. You never ever risk something you have and need for something you don't have and don't need. It's all about making sure no single loss can ever take you out of the game. And this brings us to our final law, law number 7, which kind of flips a lot of that classic Wall Street advice right on its head. We're always told diversify, diversify, diversify. But if you look at the wealthiest people, they often do the exact opposite. So why is that? It's because diversification is really a hedge against ignorance. It's what you do when you don't have deep knowledge or, crucially, control. This little grid here makes it super clear. Look, when you have control and you understand the risk, like with your own business, that's when you concentrate. You go all in because you know that basket inside and out. But what about when you don't have control and you don't really understand the risk? Think about buying an index fund that holds 500 different stocks. That's when you diversify. That's when you spread your bets out. Okay, so we've gone through all 7 laws. The big question is, how do we actually put this stuff into practice? Well, here's a simple, super powerful checklist you can use for literally any investment opportunity that ever comes your way. Seriously, before you put a single penny into anything, just ask yourself these 5 questions. 1, can this thing compound for a long, long time? 2, who's actually in control here? Is it me or someone else? 3, what's the worst case scenario? What happens if it totally fails? 4, is the potential upside meaningfully bigger than that downside? And 5, do I really truly understand how this works and what all the risks are? This is how you put these laws into action. So there you have it. We've gone through the fundamental laws of how money really works, from understanding time and control, to using leverage wisely, to knowing how to protect everything you've built. Remember, the rules are just suggestions. These are the laws. So the only question left for you is, now that you know them, how are you going to change the way you play the game?